Joining us now is Ben Harburg, managing partner at investment firm MSA Capital. He's also a portfolio manager at Core Value Alpha, and he's in town in Hong Kong. Ben, it's good to see you. Once again, I think it was a month ago, we were just talking about how bad sentiment was in the VC world, where you said live flat sentiment was at extreme lows, limited capital, limited sort of growth here. Have things changed really dramatically in the last few weeks, you think?
It has. I think it was because people weren't convinced that the Chinese government was going to take robust action. We thought it would just be a continued trickle of mini stimuli and a feeling that the government thought that they could muster their way out of this organically. And this is the first time when we felt this sustained, robust, momentum-building push from the government and oftentimes breaking rules. For instance, cash handouts, which they said they'd never do, and some of the other actions that cause us to believe that this is a break from the traditional approach the Chinese government has taken, and that is causing a really a bit of shock and positivity in an overall negative environment.
What are you hearing on the ground, though, from whether portfolio companies or your network in China? How have things? What are the changes they're looking for over the short term because of what's been announced?
They're hoping that this creates a virtuous cycle, right? So that people seeing their equity values going up means they feel a little bit more comfortable about spending. There's that $21 trillion worth of household savings stored up, and we're waiting for that dam to break, and that can flow both into the public equities as well as into domestic consumption. And that is really what could kickstart this. So we should think of what happened over the last 8 days really as more of a return to rationality in some ways, so less of a bubble, less of kind of a GameStop type spike, and also hopefully as a jump start or kickstart to the engine of the economy to restart some of that consumption. We won't see it immediately. I mean, obviously there might be a little bit better spending out of Golden Week, but overall I think we're hoping for that 2-3 quarter jump start.
Yeah, you mentioned last time some of the new trends that emerged was that there was this whole focus on overseas expansion and some of the companies. And do you think now that we've seen more stimulus, is it looking more inward and more looking at this domestic sort of inflation story more?
The outward expansion was essential because you had the flat domestic economy. And so if companies were hoping to show better numbers and higher margins, they were going to have to go abroad. But there's a risk to that. Obviously, China became such a big net exporter that everyone in the world eventually was going to go into a trade war dynamic with them because they didn't like that trade balance. And so the true sustainable growth for China also has to be developing their domestic economy, domestic consumption. And that's where unlocking that 21 trillion is so essential. We need people buying more expensive domestic products and building more expensive homes and growing out of their current stasis, and that's where hopefully this will start that growth.
Does it change necessarily how you think about your own investment strategy in China?
So we've been bulls for a long time. We started an ETF a year ago at what we thought were bottoms, and picked all of the kind of blue chip names that we thought would be the first line getting investment when something like this were to occur. So we're now hanging on for the ride, and we're adjusting our portfolio literally day by day to try to grab as much of the upside as possible, shifting between A share, H shares, and the ADRs. But hopefully, this also starts to bring private capital back to the market on a longer term basis, and that's what we're waiting for.
Do you see any sort of markets that would come at the expense of all these inflows coming back to the Chinese market? I mean, everyone's been talking about Southeast Asia or even South Asia, like India. Are you taking some profits in those markets now?
Absolutely. I mean, certainly there was a narrative, and it was partially driven by returns and partially driven by geopolitics, that we should look for, that global, particularly Western investors, should look for alternatives in, say, Japan, India. And I do think that there's a bit of a mirage that grew in those markets. India became very inflated, some of the highest PE multiples globally, with still a lot of kind of worrisome underpinnings to it, a challenging kind of domestic political landscape, a lot of crony capitalism, a faltering VC landscape where two of the three biggest VC-backed companies have folded. And so I do think there was a bit of irrational optimism about China, about India at the expense of China. And hopefully this returns people to that rationality. That's why you're seeing a lot of, New York-based hedge funds saying, go all in on China. And I think that shows you that geopolitics is less relevant. It's really just returns. If you can get the returns, you'll come back to China.
I mean, the hedge funds coming back in, it's not a surprise. It's the long-only funds that we're waiting for. When do you think we get that concentric circle coming in? That Venn diagram, as they say, that the incremental buyer to this Chinese equity market that stayed away?
We've got to see this sustained momentum in the in the upward trajectory on the public markets. I think people were waiting for the shoe to drop. They were waiting for the crash. We saw a little bit yesterday in Hong Kong. ADR is down a bit overnight, of course, and so I think people are expecting this to run out of gas. That the Chinese government can't continue to release new edicts and new stimulus policies, and so the hope is that maybe we see positive numbers out of Golden Week, of course, and then some of these companies start reporting consistent, albeit strong fundamentals as they have been, and then that kind of starts to draw back in the bears and skeptics.
Okay, so looking more at the fundamentals, is there anything in this market you think that looks quite mispriced right now?
Well, the entire China market to us looked mispriced. I mean, when
Okay.
you had companies from Hong Kong, say, trading at their, the book value, or if you had companies in China, say, a Pinduoduo that was growing at 80% a year, but was at a 9 to 12x PE multiple, and you compared that to Amazon, which was at 45. I mean, this just made no sense. And that's, again, why I say this isn't a GameStop bubble. This isn't people irrationally valuing these companies. This is people finally starting to look at the fundamentals of these businesses and saying, wow, these are good companies, and they didn't deserve to be priced where they were, and they were priced that way because of a lot of negative headline risk and geopolitics and regulatory rumor, but not truly around the fundamentals of those individual businesses.
Yeah, I'm glad you brought it up. A lot of the comparisons recently, because of how cheap the entire market had become, was against, a historical norm. And I'm wondering, because the economy has changed, the growth rate has changed, should we still be attaching, say, a 12 times PE on China, or is that sort of naturally evolved lower?
We're certainly we're much closer to being a mature economy than we are an emerging economy. The growth rates, though, are still always going to surpass the U.S. for the foreseeable future. Right. And so I think people gravitated towards the U.S. markets just because the returns were incredible. I mean, the S&P was up 20+% this year, and China was flat. Why deal with all the headline risk and regulatory concerns and geopolitics if you can get, outsized emerging market type returns from a Western stable market? Hopefully now that, companies that the Chinese market is outperforming the U.S. Our ETF, for instance, was one of the top 10 performers in the world last week. People will start to kind of come back and reevaluate these businesses on their individual merits and recognize that the risk-return profile is not as extreme as they thought it was, and you can get great returns on what is a market that's easily going to be the world's second biggest indefinitely in a growth environment that's still higher than what you get in the West.
You sound very optimistic, Ben. So I'm just wondering, is there any risks that you're looking at right now? I mean, is it still about fiscal spending and whether they can actually deliver on what people are expecting as a big fiscal boost?
So I'm optimistic just because we finally got a little bit of good news, and
Yeah.
it's been so many years of bad news that we will take what we can get.
Yeah.
Certainly, the Chinese economy has all kinds of growing pains to go through. We've got to figure out a way to grow without focusing on infrastructure spending and get out of this whole real estate malaise and shift those people to knowledge-based industries and more kind of higher-end technologies. So, definitively, we have a long way to go to evolve the economy. And again, a lot of these Chinese government policies are not going to have any true impact, right? It's more of the narrative than it is the individual impact. For instance, if you unlock consumer credit, people don't want it. They don't need it. So it doesn't mean that people are going to spend more just because it's available.
Yeah.
So it's got to be kind of these incremental measures that create that positive momentum, that people start spending both in the domestic stock market as well as internationally, and of course, buying things locally. And that momentum then can build into something over the next couple quarters that will look better.
You've mentioned you guys are almost daily adjusting your exposure and your holdings. So what are your biggest overweights now?
We've been much heavier into the ADRs. We feel, we at the offset, we were heavier into the A shares because we know that those would lag the Western indicators. And so we tried to mop up as much as we could during those first few days of the jump in the A shares. Now we've migrated back to the ADRs again because we see that volatility in the A shares. And so we've kind of gone back to our, fortress positions in Pinduoduo and Tencent and other names that we feel like have, again, solid fundamentals, but are also, going to attract a lot of that Western capital as it starts to take a second look at the market.
Mainland China reopens on, is it Tuesday?
Tuesday.
Tuesday. How do you think the market's going to open next week?
I expect it to open strong. I mean, I think people have been kind of watching what's going on, and feeling, again, this increased sense of optimism. And obviously, we've seen a huge amount of pent-up interest in the market. I mean, again, just look at the indicators in the Chinese public markets. For instance, there's only single digits of interest from large pensions and state sovereigns, whereas in the U.S. it's over 30%. Only 30% of household investments into the public markets, relative to about 70% in the U.S. So there's huge appetite for these markets if the people can start to feel that there's money to be made. So I expect it to come back strongly.
Ben, thank you so much. Nice to see you. Ben Harburg there, managing partner, MSA Capital, portfolio manager at Core Value Alpha. Just a check at markets while we were having the conversation.